Today, we will talk about excess cash flow. Excess cash flow is a term used in loan agreements or bond indentures and refers to the portion of cash flows of a company that are required to be repaid to a lender. It's cash received or generated by a company in the form of revenues or investments, which triggers a payment to the lender as stipulated in their credit agreement. Excess cash flow conditions are written into loan agreements or bond indentures as restrictive covenants to provide additional cover for credit risk for lenders or bond investors. Lenders impose restrictions on how excess cash can be spent in an effort to maintain control of the company's cash flow, yet the lender must be careful not to hinder the company's financial standing or growth. Events such as capital raising, debt or bond offerings, asset sales, or windfall income from winning a lawsuit may trigger a payment to the lender. However, certain asset sales might be excluded from triggering a payment, like the sale of inventory, and operating expenses or capital expenditures like cash used as deposits to land new business may also be exempt. There's no set formula for calculating excess cash flows since each credit agreement will tend to have different requirements. An approximation of a calculation of excess cash flow could begin with taking the company's profit or net income, adding back depreciation and amortization, and deducting necessary capital expenditures and dividends. Free cash flow is the cash a company produces through its operations, less the cost of expenditures on assets. It's different from excess cash flow, which is defined in the credit agreement, and exceptions in calculating excess cash flow might differ from free cash flow. In the example of Dunkin' Brands Incorporated, the legal terms of the credit agreement define excess cash flow based on a verbal formula with various defined terms, detailing the fine points of a definition of excess cash flow. In a hypothetical example, if a company's net income is $100, depreciation and amortization are $30, capital expenditures are $20, interest paid is $10, and taxes paid are $5, then the amount of excess cash flow triggering a repayment to the lender would be $35. Here are 3 key takeaways. 1. Excess cash flow is cash received or generated by a company that triggers a repayment to a lender, as stipulated in their bond debenture or credit agreement. 2. Lenders impose restrictions on how excess cash can be spent in an effort to maintain control of the company's debt repayments. 3. If excess cash flow is generated, a lender might require a repayment that is all or some portion of the excess cash flow amount. Hope this would help. Thanks for watching.